welcome everybody to tonight's webinar, Technical Analysis, the basics. We're going to go over several different topics today, more in like the rough line. But before we do anything, as usual, the risk disclaimer. So please do take a moment to read through this. Yeah, that's long enough. All right, so what are we covering? Well, I'll introduce myself a little bit so you have a little bit of an idea on who I am and what I do. As for the rest, we're going to look at what technical analysis actually is. Then we're going to go over how to draw your technical analysis. We're going to look at applying your technical analysis to your trading and how you utilize it for micromanagement. And then I stuck an extra thing in there for a few pointers that I just want to go over, but very, very briefly. And then at the end, for those in the live webinar, we're going to be going over the Q&A, which is basically you guys have the floor, and I will try to answer all your questions. All right, so let's get cracking. So first of all, about me. So who am I? Well, for those that didn't read the bio, my name is Mike Rotting. I am living in Greece at the moment, married to a beautiful wife with a lovely kid. I'm originally from the Netherlands. I studied international business studies there, which is where during my studies, I rolled into something called binary options at the time. I was always fascinated with the financial industry and doing trading. Obviously, binary was very, very much pushed back in the day. Obviously, it was way too gambly for my taste as well. So I rolled into what we now know as Forex. Like most, first account, not that great. Actually blew that up in a few months. Way too eager, way too, reckless. Second account, I started looking a little bit slower, trying to learn up things and follow these self-proclaimed gurus, but obviously I didn't know what to look for. So that one ended up a little bit bad. And then the third account is basically where I started throwing everything out the window and really, only doing peer-reviewed stuff and start trading my trade. And fast forward, over 10 years later, I basically rolled into an account eventually that just stayed consistently profitable on a yearly basis, that worked in a strategy that worked for me regardless of market situations. And that brought me into the financial industry a little bit differently, which brings me to what do I do? So apart from working for some brokers, like doing these webinars, obviously trying to provide some content for you to hopefully skip from especially the early mistakes that I made, learning to do several little pointers and hopefully avoid running into certain walls. On top of that, I'm also working on my CISI licensing for financial advisory, and obviously I have my own company where I do my mentoring and stuff like that. So that is me in a nutshell. Nothing too spectacular, but there you have it. Well, let's get to the stuff what you actually came here for. So what is technical analysis? So to understand technical analysis, first we need to take a look at what actually the purpose of it is. Here it is. The purpose of technical analysis is determining current trends and resistance and support points in the market. So basically what you're trying to find is market sentiment, where certain turning points are, and getting a certain feeling on how market development is that allows you to extrapolate the current data into a suggestive future data. Now, there are several different ways to do that, and when you get a little bit more deeper into it, you start looking at different variables. But in the core essence, all you're trying to do is simplify and identify current trend and market pricing levels. Nothing more. Now, there's different tools that help you attain this purpose. Obviously, we have our trend lines. We have our support and resistance, but then you also have things like somebody mentioned supply and demand zones. This is a little bit more complicated and a bit more advanced. However, they are there. There is also your indicators, right? There's also something that like price action, which again is a little bit more advanced. We're not going to get into that today, but those are all parts of your technical analysis. When you look at just support and just resistance and trend lines, this alone would not be enough to get a consistently profitable trading account. There are way more variables to this, obviously, but you need to start somewhere. So let's start at the foundation. Now, there are some rules to this. So the most important rule is if you talk about trading based on technical analysis, it's understanding that your market is not looking at a line on a chart. That is not how the market moves. We, as retail traders, are along for the ride. That's it. If your mindset is, I will beat the market, you've lost before you have even started, because you won't. There are much bigger parties at play that actually make the markets move, that are actually the ones investing in the underlying security, that are actually doing the actual volume. We just basically see a CFD, a contract for price difference. We just see the difference in price changes and we go along with that flow. But that doesn't mean that you can't understand how that works and work with it. And technical analysis helps you identify where things might be going and how they have repeating patterns and what levels, which helps you with your entry and exit, which we'll get back to later. And furthermore, when we're drawing technical analysis, and don't worry, we're going to do this all on a chart a little bit further. The one rule that you always do is something called a top-down analysis. No matter who you speak to, that's the golden rule. You start at the highest time frame you work with and work your way down. Now understand that if you start in a week overview, just to have a good overview of what's really happening, where did it come from? Where's it headed? Right? See the development. But don't look back 10 years. Okay, so a lot of people, when they do technical analysis, when they come to me, I see them, okay, so I looked here, but this is a historical value in 1985, like, we heard. Yeah, okay. The market in 1985 has absolutely nothing to do with the market in 2021. You can't even compare them with each other. It's not even like comparing apples and pears. It's more like comparing bricks, with oceans. Like, it doesn't make any sense what you're doing. Sure, certain price levels might be slightly similar, but you have to factor in that the economy's growth and different fundamental reasons and drivers are changing along the way. So when you start charting, so start doing your technical analysis. So let's say you do a week first and you trade in 1 hour. Let's take this scenario. You would start in a week and do your resistance and support and trend lines there, then draw them in a day, and then you do them in an hour. Now, if you would be trading on, let's say 15 minutes, don't do the same thing. Don't do weekday, 4 hours, 1 hour, and then 30 minutes, and then 15 minutes. Because if you would do that, then you would have so many lines on your chart, you can't actually read the chart anymore. The maximum is 3 time frames that I would advise. Don't do more than 3 time frames, because in the smallest time frame where you see all the lines at once, you won't be able to tell what you're looking at anymore if you have more than 3. It becomes so clustered, especially when you start adding your indicators on top of that, especially if it's an overlay like a triple moving average, and you're actually trying to read something and all you see is colored lines all over the place. So that's a very important rule, right? No more than 3 different time charts into one chart. And it doesn't matter what time frame you trade in, but keep in mind, if you're trading on a very small time frame, so 30 minutes and less, especially if you do 15 or 10 or 5 minutes, like, keep in mind that technical analysis is extremely flimsy there because it shoots all over the place all the time because the higher time frame overrules, right? So let's say you start on 1 hour and you do 15 minutes and 5 minutes. The 1 hour would be the ruling one, and we know how much a 1 hour changes because it can easily go through a 1 hour resistance and go to the 4 hour or daily resistance, which the daily and the weekly resistance is where it really, really gets tough for markets to push through. You really need a reason to push through that. But in 5 minutes, I can push through that 6 times a day. Like, it doesn't really matter. So apart from the fact that you would have to be pretty damn fast at drawing because you're going to have to redo it pretty much every hour. Right? So when it comes to about looking back, generally what I say is, like, when you're in a week, look back a year. When you're in a day, look back like pretty much like a month or 2, 3. Whatever is relevant to the current market. Now that's going to make sense in a bit when we look at it, where certain things I'll ignore and certain things, and I'll try to explain that. Obviously, there are these nuances and the one-time yes and the one-time no, but in the goal, we're going to go over the general ruling, so where it's applicable for 80% of the time. Obviously, the 20% is basically, you stumbling upon that over time and learning the exceptions. So when we look at support and resistance, when we start drawing those, what we want to find is basically high and low levels where the market has a tendency to turn more often. So if you have a downtrend and you have a line in the chart, now it depends where this line is, that determines whether this line is a support or a resistance. The line is the exact same thing, and a support becomes a resistance and the other way around, depending on which way the market moves. So don't get confused that they're two different things. It's the same line. It just depends on which way the market moves. So let's say the market is moving up. If you draw a line, you find a resistance point or a line above it where the market tends to turn quite often, and preferably we try to find 3 or more spots that connect with that line where it turns. Then that becomes a resistance because the trend is up and your line is above it. So that line above it is going to try and stop the market from going further up once it reaches it and starts turning it down, trying to push it down. So it's resisting the trend. And that works the same way the other way around, right? So if we're in the same uptrend, right, and I find a line underneath it, the line underneath the market price is a support line. Because once the market starts dropping, that support line will stop it from dropping too far and pushing the market back up, continuing the trend. It's that simple. And this will make sense when we draw it, and we're going to do that in a bit. Then now I'll explain exactly every line. Now I mentioned trend lines. Now trend lines are basically very, very simple. It's basically directional, right? Diagonal lines in which way the market goes. Now, they're not always going to be perfect channels where you have two lines that are parallel to each other and it's headed that way. This is the upside, this is the downside. Sometimes it's diverging, meaning that the highers get high and the lowers get low. The highers get higher and the lowers get lower. So it basically becomes wider and wider, like a pizza slice, like an inverted pizza slice. You start at a point and it's going open. So this means the range is getting bigger and bigger and bigger, which usually means that there's a very unstable trend and it can churn any different way whenever it wants. At the same time, you also have a converging trend, which is obviously the opposite, where you have a very high high and a very low low, and the points are working towards each other. So you still have lower highs and lower lows at the same time as the market moves. So instead of saying it moves sideways, what's basically happening is it is moving towards a certain point. And when you put these lines in, which I'll show you later, you will see a crossing point. Now, when it reaches that point, usually that's also near a support or resistance. In this case, it is a just turning line because it's neither support or resistance at that point. But it will have to make a choice. So you know that this is where the market will make a flip. It will either decide to go up or down from that point. Very, very rarely it moves sideways and it keeps going the same way it was. But generally it will determine a decision, make a decision there, because this is basically where market segment comes in. And we're going to get to that in pointers where I'm going to touch on that a little bit. Now the final phase, and this is where I advise most starters to not do this until a bit later, is add your indicators. Because the tendency that we have is that once we have indicators, we start reading them first and then doing our analysis and then making a decision, whether consciously or subconsciously, based on what the indicator was telling us. So if you have two indicators and they're both telling you, well, hey, look, it looks like a buy. Hold on, I'm just getting, can you guys see what is technical analysis right now, or do you guys see a different screen? Somebody's just mentioning that all they see is a summary page. But if you're waiting for the chart, I'm gonna go do the screen. I'm gonna go to the chart in a minute, guys, for those that are wondering. I'm just explaining the technical, the technical aspects of it. We're gonna go put this all in practice in a bit. Be patient. So the indicators is your final stage that you put on top of it. And if you do that when you're a starter, what happens is, let's say you have a MACD and a stochastic, what happens is you read it, and what happens is you go like, well, Okay, but the MACD is basically telling me it's going to sell, going to be a buy. The stochastic is also telling me it's oversold and it wants to buy, and the RSI is oversold and wants to buy. And then you do your analysis, but you go like, well, I want to find a buy. This is what happens subconsciously. So I really advise anybody that's a starter to not use indicators because it muddles with your decision making. Once you've learned to make your decision making on your own, regardless of what you're seeing on your screen, and that's really hard because we're just very easily be influenced. Once you get to that point, then you start adding indicators to basically confirm your findings and not influence your findings. Right, that'll make sense later. So let's actually draw some stuff. So let's start with trend lines because this is usually where your starting point is. Now, can everybody just confirm to me that you now see an MT5 screen? Who's taking this one? Yes, yes, all good, perfect, awesome, thank you guys and girls and whatever you identify as. Right, so here we go. So as you can see, I grabbed euro US dollar here, everybody knows this pair, and we started at a week. Now, by the way, for the people with price action, this might be a little top, but we're not gonna go into that today. So what we will look into is, okay, so we need to determine a trend. Well, this one's actually kind of funny because in a week, what do we see? Well, two things. And we said, let's start with the trend lines. So let's start with trend lines. Well, the highest point it is, first of all, we have all these wicks, right? When you draw your technicals, it's really annoying to have all these wicks because it kind of clusters what you're trying to look at. Go to a line chart. Look how smooth it is. Now we have a clear view of the top. Obviously, this was indicative of it starting to go down. We have a top here. This top was lower. Boom. So we already know that in a week, we have that one. Now let's do the lowest point, which always starts at the lowest after the starting point. So we now fix this to this and this. And it looks like it's almost parallel to each other. And I'm pretty sure, so even though it looks like it's going straight, it's not. Because if I would do this, which is an equidistant channel, which draws two lines at once, and I now move this to let it just fall into place, we have this little peak over. Now, with trend lines, another rule. Trend lines do not cut through the chart. Also, yes, Chris. So here we can see, it's cutting through it a little bit. Now this would have technically meant that because this is obviously a gap opening, the market price closed here. Let me just zoom in a little bit. So you already know that this was probably a Friday. So the market closed here, right? And it opened here, there's a small gap, and it went down and it closed outside of your weekly trend. Well, that doesn't happen. So this is not an equidistant channel. Now, if I would move it like this, and I take the wicks into consideration, it fits. If I take the highest point here into consideration, it fits as well. But then I can say, well, now it fits like this. So now you start muddling around with stuff that you shouldn't. And this is why you don't want the wicks. So when we just say it's not a perfect channel, we go back to the line chart, bam, and this one, bam. Let it fix on there, bam. So this one is a good example of, even though it's extremely slight, we have a diverging channel, right? This one is obviously stable at the moment, but the one on the bottom isn't. This is from the highest point where it first turned, came back, turned, and this one is from the lowest point, and it turned again there. It went up, and now it's priced here. So we know now from our trend line on a week what we're really looking at. This is the range we're working in, and then it's slowly increasing, which makes sense, right? And we see that it's slowly increasing on the bottom side because this one is obviously a bit more linear than this one. Very, very slightly in this case, it's barely noticeable, but in this case it is, which means that there is more selling pressure than there is buying pressure at the moment, which makes sense. You're at a high point, right? Look at where the market price is. right? This is where market price does come into play, right? A high point is 122. That was the highest point. So we know that it is at a high price. Doesn't mean that it can't go any higher. And yes, correct. Every bar is a week, Roger. So don't look back, like, oh my God, so let me do, because this is what I mentioned. Like people do this. Yeah, but this is the market price. Yeah, but look here, in 2009, it went all the way to 150. Yeah, exactly. Post market crash. And we had a pandemic. This was March 2020. Like maybe not relevant anymore. This market isn't even relevant anymore because we're recovering from all this nonsense. So basically in this scenario, you would say like, well, I cap it off at just after March 2020. This is the relevant market information for me. And more importantly, this part right here. Recovery of markets back to previous levels. And now you get a sort of normalized, stabilized market now that all the vaccinations are going on and everything else. So you understand, obviously, there's fundamental drivers and other geopolitical pressures onto the market. But try to use logic sense on what market would make sense to measure. Obviously, market of 2020 March doesn't make any sense because that was obviously all over the place. And oh my God, vaccines are coming. And some geriatric donkey became the U.S. president and all that kind of stuff. So everything became one big mess. So take that into equation. So we did it 1 week. Now let's say we want to trade in 1 hour. Should I do a day or an hour, or 4 hours and an hour? Well, in this case, you want to do a day because after the week, the day is a little bit more the shorter frame. Now you might think, well, hey, this line is cutting. Yeah, but remember, this is a week trend line, or it's not. So when you are in a day, and you're on a Friday, and you're close to this line or this line, I'm not looking at the day chart. I'm going to be looking at a week chart because I know where the market closes on the relative market price. Right? So if it's closing for the week, I want to know where the week closing market price is, not where the day closing market price is because it don't matter. The week is overruling. Week is higher than a day. Duh. Right. So moving on. What do we see in a day? Well, we kind of have two different signals going on at once. We have a little bit of a rally, but is it really a rally, right? Some people will say, okay, we have this. Yeah, okay, but you had the recent drop, then a pullback, up, down. So let's take that into equation. Let's take out all the noise. We got a clear view of what's going on. Right now, it's in a downtrend and it's still pushing down fairly hard. So let's do the bottom as well. But you can already, yeah, here we have a little bit of a shootout. So it's diverging here. So here as well, there's more sales pressure than there is buy pressure, which makes sense. We're in a downtrend in a week, so in a day it's going to do that as well. So for this market to do a recovery run back up to the top of the week, it needs to break this line first, right? So when you're doing short-term time trading, so what we're going to do later on in an hour, our first market is from here to here, not from here to here. That would be more a swing trade. If you're trying to pick this point, you would go in now and you set up to take profit, like extrapolate it, like, and you extrapolate it this way. Like, okay, so if the market would go that way, it would hit it somewhere over here, right? So you would take factor that in. But at the same time, well, we have a bit of down pressure, and in the resistance and support, we're going to see in a minute that there's more to this than just this. But one other thing is, if we're going to draw 3 time frames, we don't want to have the same color lines because then we can't tell them apart either. So let's make them different. So you just right click the lines, color code them, bang. Now I know that this line and this line belong to the day. Now I can even go as far as saying visualization, I only want to see this in a day and lower, because this is an irrelevant line for me in any higher time frame than that. So if I now go back to a week, poof, for some reason the bottom one didn't listen. Why not? Day. Oh, I did it the other way around. My bad. So boop. This keeps your chart clean when you're looking at the bigger picture. And obviously you can already understand we only did 2 trend lines. Now we have 2 things to keep in mind. End of the week, this is the day. So you can see within the day, it's allowed to go through the week and go here. As long, well, this could be Wednesday, for instance, but as long as the Friday closes above this to stay within the trend. Otherwise, you might get an acceleration, a breakout in favor of the trend, which usually means it keeps going and doesn't have much of a pullback afterwards. If you have a breakout against the trend, usually there's a pullback. But again, that's a little bit more advanced, just market things. But anyway, so let's do one more. Let's go to the hour, and you can see we got a nice clean chart. We see everything, and the reason we're losing a line chart is because we have a nice and clean. And here you see that little tip that we're looking into a day. That is what you want to know in an hour. Like, okay, so in an hour right now, we're doing this. So this is where all that comes from. So this is more like an hourly trend than anything else. So, and we have that one light blue. So let's go back to a line chart and zoom in a little bit. The green one was the week, so we're quite away from the week, but within the day, we're getting close. Within the hour, we're going up. So basically the way you would think right now is that if this would be here, I would have a buying opportunity in favor of the small trend, not the big trend. So it's slightly risky because it's a double down trend. Week down, day down, hours up. Smallest time frame is the only one going up in reality. So ideally, I want to buy first sell, but there's not there right now. So if it would be here, you would go for a short-term time frame trade. So let's say, probably like an 8-hour trade or something like that. If it was somewhere over here, right? If you would be over here, and then you could trade this part, which would be about a 16-hour trade for 50 pips. But if you look at the bigger picture, you're basically trying to wait for it to get here and then take the sell instead down. But you wait for the day to close because it could close outside of this, that it hasn't done before, actually close outside of it. And then you get a continuation where you could probably find a buying moment for it to go all the way up, which is against the trend. So this is where your risk management comes in, where you do take a little bit less risk on that trade, et cetera, et cetera. Q&A will do that. Now, we did our trend line. So we know from an hour that we have the bigger time frames are both down. Week is clearly down. Day is clearly down. Now, an argument can be made for week, by the way, where people go like, well, what about this? You only have one connection point and one connection point for it to be a sideways movement in this scenario. Just pointing it out. So here we have down, down, days are down. We know the weekly was very, very slightly diverging. We know that the day is a slightly diverging trend as well, that you could tweak a little bit, like, you can pull this down a little bit and pull this up a little bit to make it a little bit more linear. But generally speaking, you should just, rule of thumb is just go with whatever the original thing is, because otherwise you start messing with the lines to make it fit your argument. And that's dangerous because then you start trying to create a trade that doesn't exist. Let the market tell you what's going on and just accept whatever the market tells you, that's what's going on and not what you think is going on. Right? Remember the mindset thing? Like, don't try to beat the market, you won't. All right, so we did our trend lines. Awesome. So what's the next thing? Well, let's draw our support and resistance lines. You always start very simple. Highest point, lowest point. Relevant to my current market. Now, this is the closest low point to my relevant current market because this one, well, that's the most recent one, but it only has one connection point, which is the recent one. We have this one in the middle, which is kind of like, start of the bottom, and it already went through that twice, so that's not it. Then this one, yeah, it's kind of like a little wonky everywhere in between. So the best option you have is this one, where with this wick creates 2 connection points. This bounced off the trend line, so that would make sense there. And then you can look back a little bit where you see that here, can you stop it? Here we also have a little bit of a connection point there, so there is some relevancy to that market there. But remember, this is 2018, so we don't care much about that market. It's obviously shifted since then, but sometimes you don't have anything else to go with. Here in the top, it's very obvious. We have the high point that also has these wicks, which are rejections, basically, right? The market tried to get through that once, twice, 3 times, didn't work out, turned the other way. So we know our highest point, we know our lowest point. Now, because of the market being here, this is a weak chart, guys, right? Don't start doing this. Okay, so we have this one. Okay, so let's say I take a sell. Where's the next one? Oh, here's a good one. 1, 2, 3 points. So there's probably one there as well. There's probably also one just above this one. Let me see. Ooh, 1, and this is 2. Yeah, it's muddled. Yes, it's muddled because it's probably a day. And here it's like, oh, this is like 1, 2, 3. This is very, very 1, 2, 3, right? 1, 2, 3, 4 even. So this one, yeah. But right now you're spending time making these two analyses when this is literally like half a year away. Like the market to do this, 34 bars, 34 weeks. Like not relevant. I don't care. In 20 weeks from now, I'll redo my analysis. Don't worry. Now in this case, we don't have a clear middle. So in this case, in this particular scenario, you don't have a clear, like, okay, this is definitely where it bounced off, right? We have this. You could say, oh, a little bit of this. There's nothing really to go with. So that will probably become clear when we go to a day. So let's make this the same color as the other week, which is that green color. So let's go ahead and do that. Bam. Bam. Now, which one is support? Which one is resistance? Is down the support or the resistance? Who wants to take that one? Edgar says support. Pate says support. Top is the resistance. Support. Which way is the trend going, guys? Down or up? Right. So everything. Yes, there we go. Everybody's flipping around now. No, it's actually the resistance line, guys, because the support is this line. It is supporting the downtrend. It's preventing the market from going higher up. This one is preventing the market from going lower down, so it's resisting the downtrend. In the trend line, this is your support, this is your resistance. In downtrend, all lines underneath market price are resistance. All prices in a downtrend above the market price are your supports, because they're trying to stop the market from going up and pushing it back down, whereas the ones underneath market price are trying to stop it from going down and pushing it back up. Right? Does that make sense now? So in an uptrend, it's the other way around. In an uptrend, all lines above market price, resistance, resisting it going up. Underneath market price, support, supporting it going up. All right. So now that we have that in check, let's go take a look at a day. What color did we use on day? Blue. So let's put blue in. I just randomly slap a line in there. Bam. Change it to blue. All right. And obviously, visualization wise, we only want to see it in a day and lower. Bam. All right. So let's take a look at a day. Now, what's important to note here is please don't do this. It's like, you already have a week here. If it's close to the week trend, I don't care about the day line anymore. The week overrules the day. So I just want to find the ones that are relevant for day. Okay, so we got a little bit here. Yeah, it's very close to this line and it's close to the trend line. So probably it's going to be ruled by the weekly line at that point than more than the day. Obviously a little bit dependent on time of the day, but so basically, as you can see, I'm just moving down, but you can see with all the wicks, it's very cluttered. So we go back to line chart. Now we have a clear overview of like where's actually turning points. Okay, here we have 1, 2, 3, 4, 5, 6 connection points. I would say fairly decent. We'll lock that one in. All right, moving on from there, just moving down. 1, 2, 3, because this one you can probably guess with a wick it's going to hit. So let's check. Yep, there you go. 2 wicks rejected by the line. Okay, bloop. Go back here. This is a bit muddled. Obviously, it just went straight through here, but that's okay. It is still relevant based on this. 1, 2, 3. So we have 3 connection points, so we're going to keep that. It's probably a smaller time frame. It's probably like a 4-hour resistance, but that's okay. So here's where it gets funky. Yes, yes, no. So these 2, 3, but it's so close to this line, it's probably more like a small time frame at that point. So here we have the start of the recent price. We have those 2 and that one. The distance is roughly equal. Now that's interesting. So let's keep going. Let's now do just out of sight. Oh, wait, hold on. 1, 2. Oh, this is probably 3 with a wick, isn't it? It is. Interesting. Not as strong as these other 2, right? Because it went through and then got rejected again. But there are different reasons where that can happen. It could be fundamental. But let's see, keep it in for now. And let's take the exact same distance again. 1, 2, 1, 2. And we see here it shifted a little bit. So here we were also at the trend line, but we're also at the equal distance from there. So if we go back to this line, 1, 2, here it pushed through but got rejected by the daily trend. And if it wouldn't have got rejected by the daily trend, it would have probably gotten rejected by the weekly and then closed over here anyway. If on the week it would have gone down and closed underneath here outside of the trend but above the resistance, then you probably get a recovery. If it would have closed underneath that, then you probably get a breakout on Monday, like where it just shoots down. But that's pending orders and stuff like that. So here we have our day breakup. So now let's go to an hour. And we can see in an hour, I can go all the way like this and do all these lines, but I don't need to because that is not relevant for an hour trade. What is relevant for an hour trade is where I am right now. So that was that. Obviously, we do the same simple thing again, right? There's no other resistance line there, so we just take the highest point as a reference point. Bloop, put that in there, done. And obviously, we want this one only to be shown in 1 hour and lower. So here, okay, we have the low point and we have this one. That's a bit funky. Like this doesn't, and you can already see that in an hourly trade, things don't follow the same rules as much. It already becomes more loose for interpretation. So the higher time frame that you can judge your entry and exit point by, like the better your entry and exit point is on a higher time frame, the more stable your trade will be. But general rule of thumb, 1, 2, 3, 4. You can confirm with this. There you go. And this one, you can see it only has 1 connection point here, but if I move it down a little bit, it did break through a little bit, but pulled back, which in an hour, it will do more often than anything else. And the lower you go, the more often you're going to see these small jump outs and pullbacks. Right? But it can close outside of this line. Why? Because it's an uptrend on an hour. If it would be a down line that it broke, then generally it means like, okay, now I'm going to go keep going because I broke the resistance. I broke the support. But in this case, this is a resistance that it broke, so it can pull back and then go back up, and that's fine because we're still going up anyway. Now, if I go back to this line chart, we see that there's more connection points on this line. So this is probably the more ruling one. This little jump into an immediate pullback, different reasons why that could be. Market opening, anything like that. So yeah, one person points out, do you have to do this every day? No, obviously not. Like especially a week, like what's going to change in the next 6 weeks? Not much. The smaller time frame, yeah, maybe, every time you want to do a trade, once a week, just clear out all the hourly ones and just draw those new. But the day and the week are not going to be ones that you need to change that much. So this is why it's important to keep everything clean, make sure that you color code things, and make sure that you set it up that you only see it in certain time frames so it stays clean and you know what you're looking at. Okay, this is very, very important. trust me when I say, let me just grab a random other chart here. I've seen this. And I say this like jokingly, but I've seen this too much. Don't mind these lines, they're just random. And we got this line, and then we also have this line, and then I also have I have this line, and I have this line, and then I have also this line on top of that small line, and I have this line here that's a little bit more tight like that one. But I also do the 15 minutes where I have my my small line here, and then oh no, oh yeah, no, just leave it. I don't want to delete it, and do this one, and then do that one, and then I have all my resistances here, and there's one here, and then there's one. Like I've seen people come to me with charts like this and go like, so what do you think the market's going to do? Well, you bloody tell me, because I'm just looking at a spider web at this point. I have no idea what I'm looking at. Like I can barely see the chart where the hell it is. Don't. Keep it clean. You only try to figure out, what am I trying to find out? What is the market doing? This is clear. Boom, in one I can see the highest point, the lowest point. There's obviously a range in between, but it's not clear in the current market price, because the current market price is between 115 and 120, which is a whole different can of worms, but there's a trend. Right? So now the last step is, now we add our indicators. Now, like I said, if you're a starter, you're not going to do this, but basically what you would have is also add your indicators at this point. So let's say you have an RSI, where is it? Or let's say MACD, that should be preset anyway, as I usually have it here. And then oscillator, RSI, relative strength index, boop. Yep, there. So you can already see, if I would just blindly look at this, my eyes would go like, oh, this is probably a sell. Probably a buy, because it's low and it wants to go up. But the market's telling me I want to go down, and it is low. So now I can say, well, there's still pressure going down, so I want to get an entry here when both of these are low, and then take the buy, which is against the trend. So I would take a different risk management model in my analysis. Right. So this is RSI MACD. You can have stochastic in there as well, and a triple moving average, but don't do too much, because again, you get the same thing. If I now also switch to, what would that look like if you have everything? You would have something like this. And this is on 4 hours, so it's a little bit more muddled. That's why an hour is a little bit better, because you break it up. Like you have a bit more distance and you can read what you can. But on a week, it's very clear. Boom. The blue lines is what matters. I have my triple moving average. I have my indicators. Good. On a day, what do I see? Day is slightly going up within the downtrend. These are the two resistances. There's one up, there's one current, there's one low. All right, I know all of that. Good. Where am I at with the moving average? The fast is low, medium is stable. So it's just stably going down. There's no real turning point. It's not turning into the slow and pressing and crossing yet. Overbought, slowly going up, overbought. In other words, RSI and stochastic wise, it's basically on the point of I want to sell, but the MACD has only started switching volume into the buy now. So more likely than not, if it is not Friday, which it isn't, it's Monday, right? This is going to want to continue its line and go to its, it could actually break it. Right? If this pressure really starts turning now, then it can break this and go here. Now then you get to the previous high point, which again is a mental block, and we'll get to that later. All right, so this could be a potential breakout on the trend, because it's a weekly downtrend that might just get broken right now. Because it's only a very small weekly downtrend. It's more of a horizontal movement than it is anything else, right? And this one should actually be here. Okay. Right, so that's a lot of stuff, right? Now let's actually apply some of this to trading. What are we at time-wise? Oh, perfect, we're right on schedule. All right, so let's apply this to trading. So first of all, let's read the analysis. So let's do the one we draw together, right? Which we've already been doing, right, as we've been drawing it, but let's just double check with our head. All right, we have a high price at 122. We have a low price, if this little thing is not in the way, 116, 116.3, let's say for ease. Then we have a slightly diverging weekly trend, which makes sense because it just got to a high point, then it has a lower high, but it also has a lower low because originally at this point, we only had that line and we could have only drawn this line, right? If the market would be here right now, then this would be your analysis. So you have a converging trend at the time, but that has now been changed because basically that would have been a continuation of the uptrend, because in that case you came from low, went up, then slightly lower because you went to a really high point. Then it's pretty likely that it's going to follow the stronger up push than the slower decline, right? Because there's more buying pressure than selling pressure. However, it did not. That had different reasons, and this is more fundamental, but so that broke. We now have this point where we're going to flatten out, but it will still try to do that push. So this could be the start of what actually is a long, slow and steady kind of like downtrend that goes up and down and up and down until it starts hitting like these levels here. But again, this is very, very far back in the market, these bottoms, but it's very likely that it wants to like kind of go here and start going back to 112, 113. There are certain market prices with certain currencies that are relevant to what markets can and will do, just because of the way that money works, right? How currency exchanges work. The euro being a very funny one in that, because the euro is not really a currency as a traditional currency. It's more like it's actually just basically fake. There's too many countries and different cultures and different economical factors going into the euro to make it an actual universal coin. But anyway, that's a whole different can of worms. Like the US is based on the US. Duh. If you had the Deutsche Mark, it would be Germany. If you had the Dutch Florint, it would just be the Netherlands. If you had the French, then it would be France. If you had, etc. So with the euro, we've combined everything. So that's why the euro moves a little bit different than most currencies. There's just, different factors to that. So keep that in mind. But for analysis, what does it mean to us? Well, in a week, what I would like to see is a drop tomorrow, this week, back to this level, so I can take a buy to the up. Because there's more likelihood that it pulls back a little bit up to here than there is it breaking out. But that's why I want to see where this week ends right now. I could go in now, but then I would take this guess. I would have to put my stop loss outside of the trend, obviously, and outside of the resistance. So this would be the stop loss, 200 pips. My take profit would be, well, about 400. So that's fine. It's a 1-to-2 ratio. I'm good with that. And 200 pips means nothing because that's either $20 or $2,000 or $20,000. It depends on what lot size I assign to it, right? That's a whole different story. But right now, well, what has it done today? Absolutely nothing. Like literally absolutely nothing, because it's barely even moved. Even if it would be at the same price it started at, like the entire range for the day was 30 pips. In other words, it's done nothing today. If you were trading today, well, you basically wasted your day. But on the day trend, we also see that we're going up a little bit. It bounced off the day. It's going towards the day. So that pullback that I want is probably going to happen when this reaches. And if this being a dead day, based on this smaller time frame resistance right here, which we'll probably see back in an hour. Oh yes, we do see it back in an hour, right? This price that it was at is this price right here. Make sense? Makes sense. Good. So, because if we go zoom out, I don't know how far you want to zoom out, but you have that other price. All right, how many days is this? 1, 2, 3. Oh wait, why am I doing that way? Current market price to here, 10 days ago. 250. Yeah, 250. Yeah, okay. Yeah, 240. So basically 10 days. So perfect. So this peak is the previous high on the day, right? This one. Let me zoom in. This one. So that's where we're at right now. So if it breaks that, we'll go here. If it doesn't break that, it will probably pull back, which is perfect, which is exactly what we want. But right now, yeah, you wouldn't trade, right? Because you're in the middle of nowhere. You're in the middle of the channel in the day. You're on the bottom of the week, so you want to look for a buy, but you're like halfway away from everything. And then we go to an hour. And an hour, it's like slowly declining. So it is starting to bend off like we expected it to. It's close to that resistance. So in an hour, I could say, well, I'll take this bet. I will take a sell because we're expecting it to go down more. That's a 14 pip stop loss versus a 20 pip take profit. It's not a perfect 1-to-2 or 1-to-3 ratio, but yeah, I could take a punt on that and take a little bit less risk. Instead of 3% of the account, I can take 1.5% of the account as a risk factor, something like that. We'll get back to that little remark in a bit. Now, obviously, when we go then to the full picture, if we do, the whole analysis and everything else, we have our indicators, we have everything else. Now, obviously, it would make sense to switch that to euro US dollar as well. Then we don't have our analysis, but let's take a look at the indicators. Down, down, increasing volume, down, going up. Okay, so that's a week. What do we have in an hour? Volume decreasing, slightly going down, so that confirms that sell. This is still slightly bailing up, so the general consensus is that it still wants to go up, which makes sense because we're in an uptrend. But this is also on the high, slowly sloping down. So sell, sell, undecided, but probably going to go through the signal line soon enough. Here, long went through medium, short. So this is also saying like we're going to accelerate up, but that probably means that it's going to pull back a little bit first. So now that we've read all that, it confirms to me that right now on a short time frame, maybe for the next, like take a 5-hour trade for a sell for 20 pips. Well, 3-hour trade actually. It should be there in 3 to 6 hours. Now, if it would go exactly this diagonal line, that means that from now to here, it will take 9 hours roughly. And it would be 15 pips. But then there's a problem that this is also 13 pips. So that'd be 1-to-1 ratio. It'd be a pretty bad trade. So preferably we want to see it go up a little bit more to take that sell on a short time frame. But what we really want to look for is on the bigger time frame, we want it to go back down so we can take a buy. In this case, against the trend, I know that, but it will be the recovery trade back up here. That would be the long-term trade trend. And obviously for the ones that have small accounts, most of you, you're going to trade everything in between. So a little bit up, a little bit down, a little bit up, a little bit down. You're going to be trading this whole train up, down, up, down, up, down, up, down. Now, if you have very little experience, not going to very micromanaging your trades because, I don't know, you work 12 hours a day, then don't trade against a trend ever, because that's the one that has more tendency. If you think about, we try to create consistency in our trading, that is the higher chance of it flipping during mid-trade, where it starts going in your direction and then it just flips, because the market pressure is for the opposite direction. You're going against the trend, right? So if I buy in a selling trend, I'm taking more risk, even though most likely it will go to the top of the downtrend and then jump back down. At the start, when you're starting, you just want to wait for the top moments, because if you do that, if you take the sell every time it hits the bottom, right? Let's take a look. So here, let's take this scenario. Let's take you take the sell every time it hits the bottom. So let's say this one, or you take a buy, sorry. So let's say you take a buy every time it hits the bottom. So here you start establishing a little bit like, okay, here you would have had a double bottom. So you could have on price action say, okay, I'll take a buy this time. You buy, and then it starts flattening out, you pull back, so you close it here. So you would have had this trade right here, boom. So that's trade one, win. You wait for it to go down, 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 down. You hit the trend line, which you can now establish. Let's say once this one closed and this one closed, so 3 hours in, you take the buy here, and then you have this wick. But if you did it right, your stop loss would have been out here anyway, so you would have been fine. if you went in here with a stop loss here, you were only outside an hourly support resistance on the, or an hourly support on the uptrend, and didn't convey in the potential of the actual horizontal support, which is stronger than a trend line in an hour at least, right? So your stop loss would have been here, should have been here. If you were here, bad stop loss. Here, good stop loss. So in that case, you would have been dipping into a drawdown, which is, sucks, but happens. Go up, and then you would probably, when you start pulling this back, you would have probably closed it somewhere around here. Most of you wouldn't have held it, so I'm just going to be honest there. You were also at the previous high. If we look at the previous high here, so you probably would have gone out somewhere over here. So that's a 40 pip trade. So that's 1-2 wins unless you had a bad stop loss. And now you're waiting for the second one. So in that little scenario, you've already made, let's say 40 here, 80 pips in the last, what is that? If you start it here to here, 62 hours. Yeah, so last 3 days, 80 pips in 3 days on one pair. So if you're wondering how people get like 500, 600, 700 pips in a week, and without even spending that much time on trading, this is how. But obviously that sounds a lot easier than it really is, because there's a lot of little nuances. There's some other points which I would like to touch. So we did indicators, we did fundamental, and we looked at how to find your possible entry and exit points, right? So here we want to preferably go in as high as possible here for the down. So our entry points are going to be here with a stop loss outside of the resistance support. Christ, what am I doing? Outside of the resistances. So here you go in and you want your stop loss outside of those two resistances. Always try to find two resistances to go outside of, because then it really needs to have a reason to go there. And this one would be with the trend, and then you just go down. But you have the bottom here weekly, so factor that in. So you would do something like stop loss here. So you would have 50 to 150, which is fine. It's 1 to 3. That's a good trade. And it wouldn't be that long either. That's like 5 days, 10 days. So yeah, 2 weeks basically, which wouldn't be that long. But obviously if you would be in a day, you would be trading up, and then you would do sells, and the sells you can go a bit bigger because you're with the trend. Now, some pointers that I want to point out. First of all, risk management. So everything is fine and dandy, like understanding how to do with, technical analysis, and you're doing indicators, and you're having Fibonacci, and you have whatever it is. It's all useless if you don't have proper risk management. The only thing in trading to create consistency in your profits is having a good, solid trading strategy combined with a proper risk management included into that. Now, that is several factors, including using percentage risk on your account per trade, not a fixed amount. 2, always have, especially when you're a smaller account, when you don't have that much room to do multiple trades at once, trade with the trend, never against it, because you just don't have the room to make too many mishaps. Your accountant can't take too many blows in a row. You still need to build up some credit first. Right, and by a small account, we're doing anything between $500 and $1,500 or euros. A big account is over 30 grand. Anything in between is like medium. I know that sounds like a lot of money, but you have to understand this is the financial market. We're talking about a $6 trillion a day market. Your $10,000 is literally nothing. Right, that's Monday morning coffee. It just sounds really degrading, but that's not the way it is. The majority of retail traders like us, the majority of retail traders, especially starting accounts, the average is like, I think 1,200 euros or something. That is the average first time account level. So that's why I say between 5 and 1,500, which is pretty much the average, you're probably going to be in the bracket. If you're over that, there's a few other things you can do with risk management, like controlling exposure. Don't have 6 trades on euro. You have no idea how many times I have that. Oh, the euro is going to go buy. I'm going to buy every euro pair. Yeah, it's going to buy against the dollar. It's going to buy against the pound. It's not going to buy against, I don't know, Swiss franc, because that one is relatively stronger at the moment. Like every single currency pair should be traded individually, even if you have a fundamental announcement like an interest rate decision. with all fundamentals. You know, this is going to affect it maybe to long term, but maybe most likely short term, especially in a spike. So you're gonna might get a spike in that on the euro on the buy, but don't put all your eggs in one basket. That's just risky. Spread out your exposure. Try to keep your exposure under 20% to every single thing. So if you have 10 trades, €2, $2, £2, 2 Swiss franc, and 2 random things. Right? It could be, if you have a bigger account, so let's say over $5,000, you can start adding some CFDs from stock. You can start adding some commodities in there, some precious metals and stuff. The technical drawing that I taught you today, that I showed you today, works on those charts as well. But please, 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 if you have $1,000 less, if you have 1,500 euros or less, don't trade gold or oil. I know everybody wants to trade that shit, but you need to understand these things move a lot, and you need to set up. This is long-term trading. You don't really day trade this stuff. Yes, you can, but you shouldn't. Yeah, I feel free, but again, this is just my 2 cents. Focus on the slow moving, the majors and the minors, then eventually you add exotics, and then you start doing commodities and CFDs and all that kind of stuff. Now, fundamentals is obviously a little bit of a tricky one in this case, because if you look at fundamentals, which is basically just your economic calendar, there you go, English is hard. When you talk about the economic calendar, make sure before you open a trade to double check if there's not an announcement in the next 5 hours, because then you're like, okay, I opened a great trade. And then there's negative news. It's like, why did I lose my trade? You didn't look at the economic calendar now, did you? So make a sticky note like me, put it on the wall next to your computer or on your laptop, or make it like on your actual screen, whatever you need to do. Double check economic calendar before opening trade. So many people lose trades because they didn't check that. And then they go in like an hour before the announcement, and then it nips their stop loss. It pulls back because generally the fundamentals don't do much in the long term. And then, because that's what fundamental drivers do, but that's a whole different story. So, these announcements, they have a little small spike, hits their stop loss, and then does exactly what they wanted the trade to do. And it's like, oh, well, that sucks. And I know this is going to sound familiar to some of you. Guaranteed. And don't kick yourself in the shin. Trust me, I've done that too. More than once. That's what I'm saying. Now, the last one is trading psychology. And this one is one where I'm a little bit, this is more pointer of don't get fooled by this. Now, when you have a good trading strategy with a solid risk management, and again, risk management mainly is to control your losses, not your winnings. Right? I've never had anybody come to me and complain that they're winning too much. I have had the opposite though, right? That's the part that you don't like, the losing part. So the only thing you need to focus on is controlling your losses. As long as you do that, you automatically win. And then the more you win, the better, great. But trading psychology, this is a little bit of a thing to come over at the start where you're a little bit, it's mainly because you just don't have the knowledge, you don't have the experience. So it's like, I like numbers, and especially when you start using a percentage system, your account starts growing. Yeah, I feel good, but now 3% means, $100, and I used to do $20. And things like this, you do need to keep in your mind that it is a little bit of a thing to get over, but it's definitely not. If somebody tells you like all you need is good trading psychology, they're full of shit. They don't trade, then they don't trade it. Then they're actually not traders, because not a real veteran trader will ever tell you that. Psychology is not a thing that bothers you during trading. Once you have your established technique and you have a risk management, that completely goes out the window. For those that are familiar with Delta Works in the Netherlands, right? There's a reason that thing runs on an AI. Because humans trying to, maybe yes, maybe no. No, you need to trade like an AI, basically. You have a set fixed rules and you execute based on them, but utilizing your mental capacity as a human to see small nuances where that might overrule. But 90% of the time, it will not, and therefore you just bloody execute as is. But even if you would never factor in the small change where it would be, then you would be right 90% of the time. The 10% that you're wrong, it means 1 in 10 trades you get that exclusion where you get that one wrong. Let's say you lose 2 extra trades out of your 9. That means you still have a 70% win rate, which you won't. Most of you will be 55, 60%, which again is why risk management is important, because even then you would make a good consistent profit on a yearly basis. You would never blow up your account because you're controlling your losses, and you will always trade with a stop loss. Anybody says, I was told not to trade with a stop loss, I don't know who told you that, but shoot him or her or it or whatever it is, but that's absolutely incorrect. Always, always trade with a stop loss. You're not going to catch everything. Even if you're in front of the computer all the time, things will slip by and it will screw you over. Always have a stop loss. Even a trailing stop loss is good. It's not ideal because it's better to do a manual intervention, but that's when you're experienced, when you know what to do. Right? So those were just the points that I wanted to point out a little bit extra on top of it. I know it's a lot of information to take in, but don't worry. For those, I know that this question is going to come in a minute. Yes, there will be a recording. It will be on Legacy FX's YouTube page, so you'll be able to find it back there. And for those that registered and came to the webinar, you'll get it anyway. Having that said, for those, like I said, on the recording for YouTube, thank you all for watching. I hope you guys learned something, and I hope to see you guys on a live webinar next time. Okay, and for everybody else, now we get to the Q&A, which is the fun part. Now, before we get to the Q&A, for those that are leaving, that don't want to stick around for this, thank you for having us. Thanks for coming. I appreciate it. Keep in mind that usually, not always, usually there is a survey sent when this webinar ends. You'll probably have it in your email today or tomorrow. This survey is anonymous, and it allows you to give feedback, not just on my presentation and me and all that kind of stuff, but also on suggestions on what you would like to see next. So if there are certain topics that we see coming up, that the broker sees coming up, like Legacy FX, when they see that coming up a lot, they will request me to make a webinar about it, and I will make that content for you guys, right? So it's very important for you to really, if you care about these webinars, you like this kind of content, fill out the survey. It really, really helps. Also, it helps reflect on me. If you thought this guy was full of shit, then say it, please. You're not going to hurt my feelings, but point out why you thought it was bad. And the opposite, obviously, is always great. Having all that said, I'm going to shut up now and open the floor to you. So, fire away. Who's got a question? Let's start at the top here. Okay, guys. Thank you. Looking forward to the next webinar, price action. I actually just did a webinar on price action a few weeks ago. Go to youtube.com, type in Legacy FX. You'll find the webinar price action that I did a few weeks ago. And I think Chris was there. Thank you. Very good information session. Well, you're welcome. Very Arendt. Glad you enjoyed it. Hope to see you on the next one. If you have any questions, fire away. Chris, when do you decide to use the line graph against candles? All right, Chris, so this is very, very simple to explain. When you start your analysis, right, as you can see here, you have like all this static, because wicks are basically static noise, right? It's where the price has been but didn't close, et cetera, et cetera. So when you start drawing lines to get a good, clear overview, if this would work, you simply go to a line chart and boom, you just have all that noise being taken away. You see, you can now clearly see where the actual turning points are for the support resistances as well. Like you have clear points. So in a day as well here, how do I close this little thing out there? Right, you have like these clear peaks, these turning points, so you have a bit clearer information. And then you go back to the actual charts. This is how you trade because it just reads better, right? Some people use this. I've never used this because I don't like it. But candlesticks, because you can read price action as well as one of the extra things, which you can't do in a line chart, for instance. Okay, I hope that makes sense, Chris. I hope that answers that question. Alan asks, how important do you think the MACD tool is? Personally, I think it actually is a very, very good indicator because it shows you not only pressure but also volume in one chart. So once you get your signal line crossing into the volume, it means that it's probably going to flip. And especially in the like day 4 hour chart, it seems to really, really listen to that quite often. So yeah, I think it's fairly important. I think most traders will have it in their fundamental analysis, in their analysis at some point. Next one. Do you use Bloomberg charting software, or which software do you use? Jeremiah, I don't use the Bloomberg charting software. I just used MetaTrader 5, which is usually provided by whatever broker I work with. Mainly because I've just used MetaTrader 4 before for years, and MT5 just feels familiar. If you have a different tool that you like, great. I would just really advise against web-based kind of planners. The only one that I would say as an exception to that is, what's it called? Trading Viewer, one of those that allows you to delete the current chart and basically trade in the past and then press play and to see how, Trading View, thank you, Alan, and then see how it develops, which is really, really good when you're trying to practice how to predict markets with like technical analysis, for instance, where you draw it, then you try to analyze it, try to determine your entry and exit strategy, then click play and let the market develop and see if you got it right. It's amazing for backtesting. Right, that's a really, really good tool to utilize. Well, obviously, Legacy FX, it's not Legacy FX, and we're doing this for Legacy FX still. But yeah, for Legacy FX, don't use the web-based browser. I'm just honest with them about that as well. Use the MetaTrader 5 trader. But yeah, the Bloomberg one, no. But I've just never used it myself. Could I explain the MACD a little? All right, Alan, for you, I'll explain a little bit. Well, actually, there's not much to explain. So the MACD is basically a moving average versus a converging and a diverging line. Right? So in a simple set, if I go into the settings of a MACD, what it really does, you have a fast moving exponential moving average, and then the slow exponential moving average. Now keep in mind, an exponential moving average moves faster than a smooth, like a normal moving average. So you have more false signals, but it reacts faster to the market, which automatically means that sometimes it gives you false signals. But when you then have a MACD, which is a simple moving average, you now get like a smooth curved out line. So it basically combines the data of 3. Now, based on all that, the scales you can play around with, I don't really ever do that because it's fine for me as it is. There are some exceptions in certain stocks. There are some commodities and oils and gold. You have like more optimized settings for them because obviously they're way more demand than price. But for most majors, the basic settings for the MACD is fine. Now, the way you read this thing is very simple. This signal line, the little dotted line, if it starts going in, so let's just follow the chart. Hold on, I need to get this Q&A out of the window. There we go. So let's take it right here. Let's start here. And if you look at the high point here, you have this signal line literally flat on top of the volume, right? So the gray lines is the volume, and then you have the signal line. And you can see that right here, the signal line moved away from the volume, meaning that the volume all of a sudden had a sharp drop, in this case, because it went down. And now it's slowly going down, and the signal line is trying to catch up. So that was already indicative, like, hey, I want to go down. Now, when you combine that with, for instance, price action, like here you have a hammer, right? Where you have, again, a rejection after a pullback. You have this massive candle. It didn't pull back because this is not an engulfing candle, right? So you combine a whole bunch of stuff here, but it got rejected on the daily resistance that we know is the daily resistance now, got down, and then it continued that trend. And here you see that sharp drop. So this is where you now see that it's about to flip. So if you're not going in yet, and let's say you're still not going in, here we have a flip. The signal line literally goes into the volume now. So here we see that the volume is flipping because you get a pullback. The signal line always needs to be flat underneath it. If it goes into it, it pulls back. If it goes in either way. So your entry would be the second it goes out, and your exit would be the second it touches it again. So here you will go out. You missed this little bit, but here it pulls back. So you basically go out here instead of the optimal here. So you lose out in about 60 pips. Well, whoop-de-doo. This is on a day, by the way. Now then you go looking for an entry again. So here you see that it's moving out. Oh, here you see that it's slowly moving out of the volume, and here it's at the flat line again. So basically it's telling you, I'm going to continue this trend. So you could even take a sell here. But let's say you don't. Let's say you want to wait for the other way around. You want to pull back. Okay, so you've been waiting, you've been waiting, you've been waiting. A few days later here, right here, you see it starting going away from it. And you also have this nice little price action formation, this doji, where it goes out. So here is where you go in. So if you would do it based purely on the indicator, this is where it says go out, go in. And you go in and then you go here. Now, obviously you would have had your factoring resistance, but if you would have held it, it would have told you to go out right here. Now this is on a day. So if we go to an hour, where's my horizontal line? Right here. So you can see that right back smack on the day here, it told me to go out and it dropped a little bit later. So if you would be trading on an hour, you would have probably gone out by here because you've basically been going flat for several hours in a row. But let's say you just had no reason to go out, then you would have gone out here, but you could have lost it there. But then you get this scenario in the smaller time frame where here again, the signal line leaves the volume where it tells you I want to probably turn. You take a buy here. Now you might think, well, that's a long way down. It's only 50 pips on a day, right? We're going in here. So your stop loss would be underneath your trend line. So that's this 50 pips, right? So we go back to an hour. Where's my horizontal line? Where'd it go? Oh, here. So we go back in and we wait and we wait. And then here is where, what did it just do? I hate it when it does that. Anyway, you saw, oh, right. That makes sense. So here we go. Now I lost where we were. Bugger. Here. So here you would have gone in and then at this point you go, you start going into profit and you see here, it's in, it's in, it's in, it's in, it's still climbing, it's still climbing. And here it starts topping out. And here, right here, it leaves the volume again. So this is your exit. Yes, it would have gone higher, but this is your safe point. So that's how you would utilize the MACD. I hope that makes sense. Let me see. Where are we? And no, I don't use, so yes, that's that one. Do I use the Sierra chart volume indicator? No, Jeremiah, I do not. And that's just personally because I've never used it. I would have to look it up and see how it would be utilized in order to really get an idea of what it is, but I've never used it. So I'm not going to tell you something about something I don't use. Same for Chris, your question, do you use Heikiashi to help smooth out noise? No, not really. I literally just use the line chart, that's it. You don't need to over fancy stuff, but if Heikiashi works for you, then just use it, it's fine. Thanks, okay, glad, you're welcome. How do you determine your entry and exit? Okay, how do you determine your entry and exit? So basically, like here, right? If you're at a chart, like this is a good example. We're looking at an up in the hourly chart. The rejection happened here. The down didn't close outside of it, well, a little bit, but you can tweak that. But here it's like it went back in. So here I would go in. This would be my entry. It's low to the thing. We know it wants to go up. Then your stop loss would be outside of the resistance. We talked about this, right? 2 at least. So we have the supporting the supporting trend line and the support right here. You put them outside of that. So that's a 20 pip stop loss. And then what would your take profit be? Well, ideally you want to go somewhere here, but you see, this line is in between from the past right here. So you would probably set your take profit like a little bit underneath this. Now, if you did it a little bit too much, you go out here, but it's about the same. So like if you would have put it here, that would probably make sense. So you would have probably gone here, here, then you dipped into, got cold feet and maybe closed it. The second one into green or something. But if you would have just waited and wait for the candle to close so you know where it closes, you would have been confirmed that again, it got rejected. And then you would have basically closed somewhere along here. So let's say this. So you would have made a 50 pip take profit versus a 20 pip stop loss. Perfectly good trade. That would be your entry and exit in this particular scenario. And I don't need to see any of this to determine that. I was just looking at this chart, and then you take a little bit less from the resistance, because usually when you start getting towards a resistance point, especially when you're going up at a high price market already. So let's say if the euro was at 123 right now, you can guarantee there's a shit ton of pending sell orders at 124. So the second that it gets to 124, it instantly, bam, hits all the take profits and the pending sell orders at the same time. So that's why you see that aggressive flip all of a sudden. Keep that in mind. Think ahead. Think where people put pending orders and stuff like that, which is usually whole numbers because we all have OCD like nobody else. Because we like, nobody does a pending order at 123.983. Because if that's the case, everybody's like, well, then I'll put it at 124 now, won't I? So, that's just, so keep that in mind. Is Bollinger Bands and MACD good to use charts? Yes, Din. Bollinger Bands basically gives you an idea of range, a flexible range where if you have a very broad jump out compared to the previous pass, it means that it's going to converge again, right? You're going to get a neck again, but if you're in a bottleneck, you know it's going to jump out. The problem is you can't quite tell which way with Bollinger, but if you combine that with MACD and technical analysis, you'll be able to tell a little bit which is the more likely way it's going to head, based on trend and stuff like that. And then you just have a average moving element in the middle. That's the middle line. It's just a moving average to give you a little bit of an idea. And then the two outsides of the Bollinger Bands is basically the potential breakout levels. Usually it doesn't go very, very far past those points. So yes, the answer is yes. It's a good to use on charts thing, both Bollinger and MACD. Oh, bugger, hold on, I scrolled all the way up for some reason. No, why did it do that? Okay, where are we at? Ah, here. Jeremiah, can you give a brief description of how you approach an asset or currency pair from fundamentals to technicals to moment indicators, especially RSI over 50 as support and retest? Right, okay. That is a loaded question, but okay, I want to tackle that one. Okay, so regardless of an asset, the way that I would start from is doing the technicals, top-down analysis like we discussed in this webinar, right? So you do that first. I look at a week. If I see something good in the week and it's close to any of those points, like a good potential entry point, then great, I'll take a look at it. Unless it's a really strong up or down trend, then I'll see in a smaller time frame of maybe I can nick something a long way. Maybe there's a good halfway entry point somewhere there. Now, if that is the case, then I do my analysis, and then the first thing I do is like, if it is indeed at a potential, entry point, I will take a look at the economic calendar, which on Legacy FX you have one as well under tools, I think. So let's go here, tools. Wait, I got the Q&A thing anyway. Tools, economic calendar, bam, I'll know exactly what's going on. All right, I know there's different sources. I'm just using the one, obviously, from Legacy FX right now. Okay, so I would look, is there anything in the next 24 hours, because usually I trade 48 hours or more, but if it is a short time frame, I can usually guess how long my trade's going to be based on direction. So let's say this trade, I go in and a buy here and I go out somewhere over here. Well, basically what I would do is look at the average angle that this market tends to go up in. Here it's a bit smoothed out, so I'll take the slower option. So this was a slow option. So I'll take that line as an indicative, and I put that overlay. So here, so I would predict this trade to take me roughly 20 hours. So I will basically just speculate, is there anything within the next 24 to 26 hours in the economic calendar based on those two currencies that I'm trading in? Same for commodities, but commodities I keep in mind, is it Monday or is it Friday? Because obviously you have pending orders over the weekend and supply routes and everything else. When it comes to gold, there's a little bit of extra stuff that goes in there that I'm not going to get into right now. But for oil, just look at production numbers for the week and stuff like that. And when it comes to stock, I just take a look at the company really fast and see where they're at with their sales numbers and everything else. I'd look at the actual stock on a third-party thing. Let me just put it that way, to see what the actual stock is doing, the underlying stock, before I buy the CFD. Unless you mean like the FTSE 500 or US, the FT, yeah, the FTSE and the NASDAQ and stuff like that. Yeah, okay, the S&P 500, fine. You'll just do whatever trend analysis and you do, I use my indicators and base it on that. Now, for your question on the RSI, over or under 50, this is only for me to, so in this case, let's take this RSI over here, levels and add a 50. And then usually I actually have 20 and 80. So I usually have it like this. Now here we have a good indication of the way that I will look at it is like, okay, I want to buy. So basically what I want to have is if it's low here and low here, moving towards 50, then I will buy it. I don't wait for it to go to the 50 because I'm a bit more confident. But if you would be a little bit earlier, you would wait for it to break to 50 so you know it's going to get a pull up and then you take it. Now here, for instance, you would think you would go wet, but you don't, because if you would go in for the sell here and you wait for it to break the 50, so you went in here, right, at the end, okay, you would go in at a really weird time in the first place, because why are you going in at the bottom of a spike? But let's say you did do that. You should have had the knowledge to put the stop loss outside the previous high point, so here, so you would still be fine, you'd just be in a down draw, and you would still have that slight pressure, even though it's going up. The day and the week are down. So there's still that pressure for it to go down. Now, obviously, that would be a bad trading decision, all right, in this particular scenario. But let's say you did that, you still have a good chance that it will pull down a little bit. So you can get out of this one. Now, if I would be looking for, let's take the same scenario here, and I would wait, then I would basically not go in right here at the bottom. I would wait for price action, which I don't have. So I'll wait for this and then this stop. Where are we? Right here. So here I would wait for it, you know, in a line with my fundamental. There's nothing in the next 48 hours. Good. The MACD is crossing through, but the RSI in this case is just crossed the 50. I already have two up candles. One got rejected. We just got off the trend. I would just like straight away grab it right off the bat. Stop loss out here. Take profit at the next high point, which obviously I didn't know what that was before this, but I could take a little bit of historical data in this case. So I go back a little bit, and if I would just purely take it on the previous past, I would take like something like this, right? So that's exactly where it stopped actually. So I would take like, boom, I would put it right there. So yeah, there you would have your trade of 20 versus 50, 1 to 2, which is perfectly fine. I hope that makes sense. I think I covered everything there. Pate, thank you, Mike. I learned a lot. Need to work on entry, exit, stop loss. Stay away from gold and oil from that. All right, Pate. Oh, I'm glad to help you. I mean, I'm not, like I said, it's not like you can't trade gold and oil on a small time frame, but on a small account, like, let me show you what I mean. If you would trade gold here, your stop loss would have to be outside of that at least. You would take a sell. That is a 270 pip take profit. The smallest lot size you can take is a mini lot, which calculates as a micro lot. So you have to do at least 30 bucks. If you have a $1,000 account and you have a 30 euro stop loss, that's a 3% risk, which is barely within your range. Then you do have a take profit over here, but that is a 20-day trade for like 112 euros. It's not worth your time. You need to trade this stuff big. You're not going to trade gold like this. You're not going to trade it on an hour. It doesn't make any sense. Like, what are you going to do? Trade this? So let's say you do trade this. Let's take this scenario. You want to trade this. And right now, let's take the scenario. It's right here. you would still need to take a stop loss over here. And the best thing you can do is go basically this market price here. So that's 80 pips and your stop loss was 60 pips. Didn't make any sense. You would have to have perfect entry points every single time to make that work. Because if you take it here, for instance, remember, this is the day. It can freely just move there and then spike back down here and then go there again. Like, you're going to get nailed. So, you know, gold is more a day trade thing. That's okay. That's a repeat question. We covered that one. How to find edge over market to use, maybe investing a com or Finbiz market cheese. Well, Roger, to be quite honest, I don't look to beat the market. This is the thing I mentioned at the start. So Roger asked, like, how do I find an edge now over everybody else in the market? The way that I find an edge is by ignoring what everybody else says and just do my analysis, make up my own mind, look at the fundamental data that is hard, not what, you know, people on the trading platform are saying. Here's the problem with that. Because then you get trading sentiment and people like to listen to like Bloomberg and, you know, what is Goldman Sachs doing, or what is Pacific doing, or what is PAM or any of these big trading firms doing. What does it matter? You're a retail trader. Who gives a shit what they do with $150 million? Like, you're not part of that. You're not even going to influence that. All you can do is go along with the ride, and the market's telling you what the ride is. They look at the chart like this. A month and a week. Like, they couldn't care less what it does today in an hour or, you know, anything like that. We look for Q1, Q2, Q3, and Q4 with an understanding that euro on average per year does about a 6% growth or maximum decline. That's pretty much its range at best. So if they want to buy euros, they go to the bank, we'll buy $2 million worth of euros as cash, and that's going to be part of the portfolio, including some real estate, including some stock, including some XYZ. We don't trade like that. So there is no edge to be get. The only thing is self-educate, make sure that you understand which news announcement are coming out that might screw up your starting point of your trade, or maybe intervene that you need to move your stop loss into the positive to secure against bursting. Because it's okay to go out at zero. Yes, you've wasted time and you didn't make profit. And I know how it feels when it goes out at zero and then afterwards it hit your take profit. You go like, oh my God, I could have won that trade. Yeah. Now I'm going to tell you to do that every single time. Don't move the stop loss. I will guarantee you're going to lose more trades than that time that you go like, oh yeah, I won that trade because I didn't move the stop loss. Again, we're trying to get consistency. So, you know, I never look at signals. I just do my own analysis. And if I do see a signal, I think like, that might be something. I will do the analysis from scratch myself. And if I then agree, then fine. But I don't try to beat the market. I'm like, everybody's going to do this, so I'm going to do that. No, if everybody's going to buy, the market's going to go up. Like, I don't know where that idea came from. Well, if everybody's buying and 70% is wrong, I'm going to do with 30% and go sell. No, the reason 70% loses is because they have bad risk management and don't have any proper setups. Like, you know how many people trade euro US dollar with a 10 pip stop loss, like guaranteed, like always 10 pip stop loss, and a 20 pip trade profit? It's a 1-to-2 ratio. Like, it doesn't make any sense. Like, you're putting stop losses in the middle of ranges where it just freely can move whenever it feels like it. You know, obviously you're going to lose 80% of your trades. So what's the edge? Use your common sense. And yes, obviously read investing.com. If I do stock, yes, if you do stock, then obviously read up a little bit on, is there anything going on with the stock market in particular? More on a global economic like point of view and like politically, and for the company specifically, especially if it's like Apple or Microsoft or Netflix or, you know, things like this, Zoom. Like, if I do some stock trading in that for a day or something, I'll double check what's been going on, how's it been trending, what's the rough average daily growth, stuff like that. But again, that doesn't give you an edge. That's just doing your due diligence to understand what the hell you're trading. I hope that makes sense, Roger. So there's no way to beat the market. Let me put it that way. Didn't I answer that question? We answered that question. Oh wait, we're going back. Wait, hold on. Josephine asks, would you be comfortable taking a trade against the trend? Like in your example, in your US dollar 1 hour chart. Yes, I would. I have more experience and I know exactly where markets will probably go. I know how to micromanage the trade against the trend, and I have an account size that allows me to take a few trades against the trend that are more risky. But Josephine, very important. When you have a small account, just trade with the trend. Be patient and just take quality trades over volume trades, right? You just want to wait. It's okay if you only do 4 trades a month. If the market provides you with a good trade, take it. If there isn't a trade, don't try to force something that isn't there. That's how you lose money. Now, when my risk management on my appetite has gone up a little bit, I have a 5% account risk per trade that I am comfortable with, that I'm really, really confident about, just a good trade. And I take half that in a trade, like let's say against a trend on a short time frame, like here. So I would take 2.5% risk on the account. Keep in mind, if I do 5%, I can take 10 trades and only utilize 50% of my capital. I'll still have capital left to play with, right? So I can never zero out my account. Like, it just doesn't happen unless I like really do something weird. And I would actually have to, like, you would literally have to randomly click open trades. Within that, obviously, you know, risk management. I could also just take like 50 10 lops and no stop loss and just randomly click a direction. Yeah, eventually it'll run out of money, obviously, but like that, you don't trade that way, obviously. Now, for that's a webinar on its own. Yeah, Alan, it is. All right, I hope that answers your question, Josephine. For Alan, what about ATR for your stop loss? Now, it might be because I'm late, but what do you mean by ATR? Just help me out here for a second. Do you mean the average, like daily range, the 80? Do you mean that one? Don't worry, everybody that has questions. I'm going to get to all of them. Oh, the ATR tool. No, I learned how to calculate it myself, so I just do it based on my own calculation, but you could use an ATR tool, that's fine. So generally what you want to do is, if I have my stop loss, I just base it on my technical analysis, the initial one, and what I generally do as a rule of thumb is either 50% into the take profit, I have the trailing stop move to 0 and then have a trail running if I'm not going to be in front of the computer, let's say most of the time anymore. I didn't do that when I was literally just trading all day as only thing I was doing, because then I'm looking at the charts, I'm in control of my chart, I can move it manually whenever I want. But what I would do is, let's say if you were on a day trade, I would factor in the last 14 candles and calculate the average daily range out of that, and then basically take that plus 20% for my trailing stop, because that means it would have to do more than the average range against my trading direction in order to hit my trailing stop. So it should usually hit take profit or trailing stop when it pulls back enough. But that only rule is only if the average daily range was less than 50% of the trade, because otherwise I'll be risking more than 50% of the trade for no reason, if that makes sense. So yeah, there's that. Okay, going back up, let's see who's next. Chris had to, okay, all right. Well, he left, so okay, good. But thanks for the kind words. MACD, Grant asked, can you give me the MACD settings? Grant, I'll make it better. I'll up you one instead of just telling you like, well, here is the MACD settings. There is a webinar I did on indicators for Legacy FX that went through MACD, RSI, stochastic, Bollinger Bands, and triple moving average and settings and how they work. Go to YouTube, type in Legacy FX, and you will find a webinar called Indicators, and just watch that one, and it will explain everything, including different time frames and stock versus commodities and stuff like that. I'm pretty sure I covered that as well. Well, obviously that's quite a lot of information. So yeah. Roger, thanks. Nice explanation. I'm glad you liked it. Jeremiah, take for example 4-hour time frame and comparison to 30-minute time frame. Is it safe to say that a 30-minute time frame is a makeup of the 4-hour time frame that can be used to more accurately establish the entry? Yeah, but I would say use an hour then. So basically what Jeremiah is asking, if you have a 4-hour chart, would you utilize a 30-minute chart to judge your entry point? Yeah, if you're trying to find the exact spiking moment just over that line, yes, you can. But in generally, all the ones that have an M in front of it are the riskier trades because that one doesn't really adhere to a lot of rules because it's a very fluent and a very volatile, I say that between parentheses. It's a very like switching market. So an hour would be better for that question, Jeremiah. I would use an hour and basically use that as an entry. But yes, your answer question is yes, you can utilize the 30-minute for judging a slightly better entry point, like that spike moment, and then switch to 4 hours and continue your micromanagement of the existing trade there. Roger, thanks for your input on signals. My pleasure. Yeah, I have a little bit of a love-hate with signals, but that's a different story. Okay, somebody asked about what is the difference? Okay, can you explain what leverage is? Yes, I can. So let's how do we do this? Right. Okay. So I want to kind of explain the textbook definition, but I don't know that top of my head. So let me just put it the way that it is. Leverage literally is your little bit of money becomes more money. Every $1 you put in gets multiplied by an X amount. This is basically a loan the bank gives you to trade in the market. So if you would trade a mini lot, which is $1, you're not actually risking $1 of your account, because what happens is you, relative to your account, are trading $1, but the market doesn't accept $1. So you need to multiply that and by 100 because the minimum is a standard lot. So you get 100-fold. I hope that makes sense. So when you know, a higher, if you go to 1 to 500, you need even less money to trade in the market because it gets multiplied multiple times. When you go lower, there is less of a multiplication, so you have less of movement. It's more direct. Now, this means that, this is a bit hard to explain, it's basically a webinar as well, but basically what happens is you are increasing your range to make profit, but also loss. So as you increase the multiplier, you also increase the multiplier for loss as well as profit. But basically, it's just a loan. For every dollar you put in, it gets multiplied by whatever you put in next to it. So 1 to 100, you put in 100, it gets multiplied by 100 by the bank, and then that opens a trade. So that makes you having an actual equity on the market, the value of your trade. Right? Without leverage, we would not be able to trade. Let me put this way. If you are going to a bank where you would have to open the trade without brokers, they wouldn't exist. Right? You want to open, you only have the option to trade one-on-one. Now, most banks will have a minimal ticket, which obviously is not going to be 1. The average is 5. And I mean 5 standard lots. That means that you need to put in the value of 5 standard lots into the market. That means that if you want to trade 1 standard lot, let's say the bank will accept 1 standard lot, on euro US dollar, buying euro, you will need to bring 100,000 euros because that's the value of 1 standard lot. And then you have 1 position for buy. That's it. Obviously, most of us don't have that. So the broker existed, which is basically the middle ground. They have a bank deal that gives them a free loan and a lot of money, and it allows you to play with leverage. So now you don't need $100,000. You can do with $1,000 and still trade on the market because the bank will fill the rest. Now, obviously, there's different systems in place to make sure that the bank never loses and only wins, but that's a whole different topic. But based on leverage, it allows you to trade with 1,000 euros, where normally you would need to pay per standard lot, like straight up $100,000 per position. And usually the minimal ticket is 5. So, and the more you put behind it, the higher the multiplier. So the less you need in order to trade. It's that simple. The other way around. So the smaller the number, the less you need to trade. the less your equity moves. The higher the number, the more you move, the more range you have, but also the faster you can lose money. So it's a knife with two edges. Josephine asks, how much do fundamentals affect the trend? That has significantly changed over the years. That's a really loaded topic. I did do a webinar on fundamentals and explaining that a little bit, but basically in essence, you have fundamental drivers, which is the underlying value that gives a currency its value. This is why the euro is so weird, because the euro has multiple different economies underneath it. The US dollar is very simple. You have the US, which is the federal banking reserve, and gold and the economy, period. That's it. You have the Middle East, obviously their currencies are mainly based on oil price. Duh. So China is very reliant on actually exports, so that's mainly the driver for them. So the trading balance. And then you obviously have the banking interest rates. Now, how much does it affect the trend? Well, that depends. Obviously, when an economy is growing stable, it is a strong currency because the internal economy is strong. Then the currency is strong relative to weaker economies. Let's say Greece was still an economy on its own. The US dollar would be significantly stronger than Greece because Greece is based on tourism, so it's very seasonal, whereas the US has a very strong internal economy all year round, right? So then you get this lopside. For instance, the Netherlands would be a lot stronger than Italy because Italy, again, is a very touristic place and they don't have much of an internal economy. It's very, very clustered. There was a lot of corruption and stuff like that. The Netherlands obviously still had corruption, but it was a really big import-export kind of country, and it was basically the Europort, right? You have Rotterdam, you have Schiphol, so there's a lot of goods going in, so you have a lot of trade, right? So this is how the individual currencies, they determine how currencies grow. Now, as for trading on trend, that is the economic calendar. Only few, and that has become significantly less. For instance, 10 years ago, yeah, 10 years ago now, geez, I'm getting old. Anyway, 10 years ago, the GDP, right, the NFP, the non-farm payrolls for the dollar would determine which way the dollar would go for a week. Positive, it will go up for a week. You could literally blindly trade on that. Nowadays, it does a move for maybe an hour, comes back to wherever it was and just continues whatever it was doing before that. Completely ignores it, unless it's extremely out of the way. Right? So when it comes to smaller things, obviously when you have the bigger ones, like what do we say, the interest rate decision I mentioned, when it's something like that, then usually you see a day before, because that's when the numbers already start getting, word of mouth, like you get a little bit of leakage. The market starts preparing because usually the numbers are fairly factored in already, and most, if you dig deep enough, you can kind of already know what it is before it even gets out. This is why we have prediction numbers. But that's basically the market sentiment, the expectation. Now, if it then highly differs from that, you're going to have a shock reaction, which means it's going to either accelerate or decelerate, and that will affect the trend for at least a day or two. But when you talk about like a weekly or monthly trend, generally not, because all this is factored in and this is more in the drivers. So on short term, yeah, you get spikes, but not really trend defining unless it's something like fundamental driver related, like an interest rate decision. I hope that makes sense. Jeremiah, quick question. Are you a millionaire trader? Just to know if your advice in this webinar is coming from someone who we need to have tremendous respect for. No, halfway there. Let me put it that way. And kind of rotated out of retail trading. Like most of you, I started with $1,000. You don't turn that into $1 million that easy. Let's be honest. But no, I'm doing good. Well, a little over halfway to that mark. But it's rotated out of retail trading more. I still have like a 10 grand account somewhere. I'm not going to get into that, but I do some day trading for myself, obviously, and a little bit for examples. But the other side is that most of it's in multi-asset trading and things like I mentioned before, like Pacific and PAM and Goldman, this kind of investment vehicles and structured notes and stuff like that. Because day trading, let's be honest, day trading is high intensity for little returns if you think about it. unless you really sit on top of it 24/7 and really only trade this. And I've tried that for 2 years and tell you one thing, this is the most stressful time in your life. I think I aged 30 years in 2 years because I didn't know if I could pay the bills at the end of the month, because you're reliant on whatever profit you can pull in. And if the market isn't moving, you ain't doing anything. So, you know, that's, you know, a very bad way to live, I found out. But yeah, no, on average, I do okay. But I'm not going to get to that too much into the Jeremiah. So it's more like up to you yourself if you want to believe whatever I say or not. It's, you know. There you go. Grant, you're welcome. Jeremiah, thank you for all the your time so much. Do you have a Telegram channel? No, I don't do signals. I do mentoring, but not signals. There's no point in following somebody else. It's better to learn how to trade yourself than just follow somebody and have no idea what they're doing. Like, I don't believe in following. Just learn how to do it yourself. But you can utilize somebody that gives it. Thank you for the answer. But finally, do we have specific leverage for a certain amount of example, 500 US dollar gain? General rule of thumb, Portafi, just use 1 to 100. Don't play around leverage too much. Just use 1 to 100. You're fine. Like for $500 is fine. Jeremiah, I'm not going to read that question out loud, but I highly doubt. No, let me even put it this way. Even if he did do that last part of your thing in 5 trades, the amount of risk he had to take on those trades far outweighs any logical risk management. So that was just getting lucky 5 times in a row instead of actual good trading. And if he has that type of account, that's probably a joint account or a demo account. If it's just purely his, then I don't know why he's retail trading. Because with that much money, you don't retail trade. He would put a lot more in completely other things that are way more profitable for way less risk. So I have a lot of red flag questions there, but I'm not going to get into that. If that's the case and you believe that, fine, go for it. Yeah, but I don't believe that it didn't happen, Jeremiah. It's for me that the risk you have to take to make that much with that little in 5 trades is not sensible trading. That's gambling. You get lucky 5 times, great. You don't, you lose everything. Like that's literally just pulling the lever into. Let me put it this way. You can do the same thing, go to the casino, put everything on black, do that 5 times in a row, all in. You understand what I mean? Like that's the way you're trading then. I'm not saying it can't happen. Obviously, there are stories like this where that happened, but I would have a lot of like things to look through. But yeah. If he works for you and you like his style and you're getting somewhere with that, then it doesn't really matter what I think. If it works for you, it works for you, and you then just do it. Right? I'm just giving you my 2 cents. It's just how I am. Right. Does anybody else have any other questions? Okay, Jeremiah, like put this in a logical sense. If I buy a mini lot on one and then sell a mini lot on the other, what am I doing? I'm hedging myself, so I never go up or down. So that doesn't even make any sense. If I go up $10 on one and down $10 on the other because I'm trading the same thing, I go up 0 because the negative covers the positive. Like that. Anyway. Yeah, but yeah, I think you're missing the point, Jeremiah. If yes, all right, Alan, you're welcome. Have a good one. Jeremiah, what I meant is if you blow up one account and win on the other, right? The amount you went down on the one account is equal to the amount that you went up on the other account. You still went up 0. If you both have $1,000 account and you lose 1,000 on one, you've made 1,000 on the other. So you're still zero because you need to compensate the loss. And then everything he trades after that is profit, sure. But again, this is a very risky trading strategy. It doesn't make much sense to me. But if it worked, it works. Fine. You know, there's plenty of different people, and there's plenty of veteran traders as well that'll look at my stuff and say, like, you know, you suck. I'm like, okay, fine. You know, it worked for me. So, you know, it's there's no perfect golden rule on how to trade, really, in the end of the day. There's some stable rules, like the things we went over today, but how to actually, you know, trade what you want to trade and do stuff like that. Yeah, there's a few like ground rules, but in the end of the day, you need to do you, and everybody has a different taste for risk. Everybody has a different taste for what they want to trade, et cetera, et cetera. All right, that said, does anybody else have any other questions? You're welcome, Jeremiah. I'm gonna take that as a no then, and we kind of went over the time, I think. What time is it? Oh, Christ. All right, well, it was a good Q&A. Having that said, everybody that was in here, glad I was super that you guys all were involved. I really love that kind of stuff. I hope everybody learned something. I hope you can apply it to your trading. And you know, for the next webinar, I hope to see everybody again. And remember, if there's the survey at the end, and if you go to Legacy FX on YouTube, you'll find other webinars that I did. Feel free to look through them. Yeah, and just utilize that. All right, there's a bunch of information. Also, when you join Legacy FX, just as the last thing, they have like a whole education center for free that you can tap into. So, you know, that's, you know, not most brokers have that. So utilize it if you want to. All right, so for me, everybody, I want to wish you all a very, very pleasant evening or day, wherever you may be, and hope to see you on the next one. Thank you. Cheers.